It's 2:17 a.m. and the glow of your phone feels like a courtroom spotlight. You're not scrolling for entertainment. You're doing math in your head that you didn't want to do. Retirement, age, time, and that quiet sentence you'd never say out loud, I think I'm late. If that's you, listen closely, because here's the promise, plain and simple. By the end of this video, you'll know exactly how to reach your first $100,000 for retirement, even if you're starting late, using a Benjamin Graham-style framework that prioritizes protection first, progress second, and only then growth. So you stop gambling with time you don't have and start building a plan that can actually survive real market. And yes, I said survive, because if you're starting late, the biggest danger isn't that you'll earn a slightly lower return than someone online bragging about a perfect chart. The biggest danger is making one mistake so big it steals 5 years in 1 week. Late starters don't lose because they're late. They lose because they try to erase lateness with risk. So let me ask you a question that's going to quietly run underneath everything we talk about today. If time is limited, what matters more? Higher returns or fewer fatal mistakes? Most people assume the answer is higher returns. That's what the culture screams at you. More, faster, aggressive, catch up. But Graham, quietly, stubbornly, would argue that the real superpower isn't speed, it's discipline. The ability to say no when Mr. Market is yelling yes. If you remember nothing else, remember this image. Mr. Market shows up at your door every day with a price tag in his hand and a mood on his face. Some days, he's euphoric and tries to sell you the same thing at a ridiculous price. Other days, he's depressed and begs you to take quality assets off his hands for cheap. Your job is not to match his mood. Your job is to use him, not be used by him. Now, why are we talking about your first $100,000? Because the first $100K is the hardest money you'll ever earn. Not the flashiest, not the most exciting, but the most important. It's the moment where momentum starts to replace struggle, where your contributions are still the engine, but compounding finally starts to feel real instead of like some fairy tale. It's also a psychological shift. Once you've built $100K in retirement assets, you're no longer hoping. You're building. You're not lost in the fog. You're on a road, but reaching $100K late requires a different mindset than reaching $100K at 25. At 25, you can be sloppy and still recover. At 50, sloppiness is expensive. The margin for error shrinks, and that's exactly why Graham matters more, not less, when you're starting late. Graham's entire philosophy starts with one principle that modern finance content almost never starts with. Don't lose money, not because losses hurt your feelings, but because losses steal time. And time is the one asset you can't refinance. So we're going to build this plan the Graham way. We'll think like a defensive investor first, and only then like a return seeker. We're going to create a margin of safety, not just in what you buy, but in how you live, how you save, and how you behave when the market gets loud. And I'm going to show you a practical path, numbers included, without turning your life into some spreadsheet religion. But first, you need one truth that might sting for a second and then feel oddly freeing. There are only 3 levers in your wealth building equation: how much you invest, how long you invest, and the return you earn. Starting late means the how long lever is shorter. That leaves you with 2 levers, and only one of those 2 is truly under your control. The market does not take requests. The market does not care that you feel behind. The market does not reward desperation. The market rewards discipline and it punishes people who confuse hope with strategy. So, if you're late, the smartest move is not chasing returns. The smartest move is controlling what you can: your savings rate, your behavior, your costs, your risk exposure, and your ability to stay invested through storms. Here's the first twist most people don't expect. Your first 100K is less about picking the perfect investment and more about building an environment where you can keep investing no matter what the headlines do. Because the real killer isn't volatility. The killer is volatility plus panic. A 30% drawdown is survivable if you keep contributing. A 30% drawdown becomes a life sentence if it makes you sell, stop, and spend the next 2 years waiting for clarity. So, we're going to set up 3 safeguards, 3 layers of margin of safety before we even talk about what to. Imagine your retirement plan is a bridge. If you're starting late, you do not build the bridge to barely hold the weight. You overbuild it. You make it boringly strong. That's margin of safety. That's what lets you cross when the wind picks up. Safeguard number 1, stability. Not excitement, stability. If you don't have an emergency fund, real money that prevents you from raiding retirement accounts or using credit cards when life happens, you are not an investor yet. You are a forced seller waiting to happen. Graham would call that speculation, even if you're buying safe funds, because your situation forces bad timing. Stability means having a cash buffer, so the market doesn't get to decide your next move. It means your car repair doesn't turn into sell at the bottom. It means a layoff doesn't turn into cash out my future. So the first step is simple, not glamorous. Build a cash runway, enough to cover the kinds of problems that actually happen: medical bills, job gaps, unexpected family responsibilities. Many people aim for 3 to 6 months. Some need more. The exact number isn't the point. The point is that your retirement account stops being your emergency plan. Second, clean up toxic debt. Not all debt is evil, but high-interest consumer debt is a guaranteed negative return. If you're investing while carrying a 20% interest credit card balance, you're trying to compound while someone is actively drilling a hole in your boat. Now notice what we're doing. We're not chasing yield, we're removing fragility. That is one of the most Graham-like things you can do with your life, because fragility creates forced decisions. Forced decisions create permanent losses. Okay? Now we can talk about the engine. Safeguard number 2, the contribution engine. This is where late starters win. Most people ask, what stock should I buy? The late starter should ask, what system will make investing non-negotiable? Because the first 100K is not a mystery. It's math plus consistency. Let's make this real with an example. Assume a long-term average return in the ballpark of 7% annually, which is common for planning scenarios after inflation is considered in many discussions, though real. Returns vary year to year, and nothing is guaranteed. This is educational, not personal financial advice. Now imagine you're starting from zero and you automate $1,000 per month into a diversified retirement portfolio. At around a 7% annual return, compounded monthly, you're looking at roughly 6.5 years to reach $100,000. Not tomorrow, not next month, but not a lifetime either. Drop that to $800 per month, you're closer to about 8 years. Drop it to $500, and it can be around 11 years. That's not a motivational quote. That's a map. Now, here's the part that changes everything for late starters. You don't have to get rich. You have to get consistent. And consistency is built by designing your life so the contribution happens before you can negotiate with yourself. That means automation, payroll deduction, scheduled transfers the day after payday, a system that treats investing like a bill you pay to your future self. Because the market is emotional. You are emotional. The only way to win long-term is to remove your emotions from the monthly decision. If you're watching this and thinking, but I can't do $1,000 a month, don't click away. This is exactly where people misunderstand the plan. The plan is not pick a magic number. The plan is build the engine that can grow over time. Start where you can, then increase it with purpose. A lot of people can scale contributions by doing two things that feel boring but are incredibly powerful. Raise your income and hold your lifestyle steady longer than your instincts want to. The world tells you to celebrate every income increase with a new payment, a new car, a bigger apartment, a lifestyle upgrade. That's not celebration, that's captivity. So here's a practical late starter rule. Every time your income rises, split it. Half to your life now, half to your future. Or even better, 70-30 toward the future until you reach your first 100K. That's not punishment, that's a rescue mission. And I want you to notice something. We still haven't picked a stock. Yet this is the part that determines whether you get there. Because late starters don't lose to bad investments as often as they lose to broken behavior. Starting, stopping, restarting, changing strategy, reacting to news, chasing trends, trying to make it back after losses. This is where the question comes back. Higher returns or fewer fatal mistakes. We're about to answer it, but first you need to understand the real enemy of late retirement investing. Sequence of returns risk. Sequence of returns risk is the reason two people can earn the same average return over a decade and end up in very different places. If you experience major losses early, when your balance is smaller, your confidence is fragile, you may stop contributing. If you experience major losses later, when your balance is larger, you're closer to retirement, those losses can permanently reduce what you can safely withdraw. That's why late starters have to treat downside risk like fire. Not because you should be afraid of the market, but because you should be afraid of yourself in a crisis. So here comes safeguard number 3. The Graham filter: what you buy, how you buy it, and how you behave when Mr. Market gets dramatic. Let me say it in plain American English. If you're starting late, you do not have the luxury of pretending you're a professional trader. Graham drew a bright line between investing and speculation. Investing is an operation that, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So what does that look like in retirement terms? It looks like diversification instead of concentration, low costs instead of flashy products, a plan you can explain in 1 minute instead of a strategy that collapses the moment you stop paying attention. For most people, a diversified mix of broad, low-cost funds, often including stock index exposure and some bond or cash-like exposure depending on risk tolerance and time horizon, fits the spirit of defensive investing. If you also want to tilt toward value, you do it in a diversified way, not by betting your future on 3 undervalued names you found in a comment section. And if you're the type who does individual stock analysis, balance sheets, earning stability, valuations, competitive position, then Graham's defensive criteria are still your guardrails: financial strength, consistent earnings, reasonable price relative to earnings and assets, and an insistence on not overpaying, because a late starter can't afford to be right eventually. After a 60% drawdown, here's how Mr. Market will try to trick you. He'll show you a chart of something that tripled fast and whisper, "This is how you catch up." And that whisper is deadly because it sounds like relief. It sounds like a shortcut back to dignity. But in reality, it's a trade. You're trading peace for excitement. You're trading a plan for a lottery ticket. So the Graham filter starts with a vow. No leverage, no desperation trades, no all-in positions, no chasing what already ran, no confusing a bull market with genius. Instead, you build a portfolio you can hold through ugly years, because ugly years aren't a bug in the market. They're a feature. Now, I know the next thought, but if I'm late, don't I need to be more aggressive? This is where most people get it exactly backward. Starting late does not mean you should increase risk. Starting late means you should increase discipline. Yes, your contribution rate may need to be higher than someone who started at 22. Yes, you may need to be more intentional about expenses. Yes, you may need to work a bit longer or adjust what retirement means. Maybe partial retirement, or a later start date, or a hybrid income stream. But the answer is not to make your portfolio fragile. Fragility is what ruins late starters. Let's make it painfully clear with a simple story. Two investors start late. Same age, same income, same goal. Investor A feels behind, so they chase. They buy what's hot. They check their account daily. They switch strategies every few months. When the market drops hard, they panic, sell, and wait for formation. They miss the recovery. They start again at higher prices. Then they repeat. Investor B builds margin of safety. They automate contributions. They keep a cash buffer. They diversify. They keep costs low. They accept volatility as the admission price to long-term returns. When the market drops, they keep buying because the plan is the plan. The difference isn't intelligence, it's temperament. Graham understood something modern finance content hides. Your biggest advantage isn't your ability to predict, it's your ability to endure. Now we're ready to answer the question, if time is limited, what matters more? Higher return or fewer fatal mistakes? The honest answer is fewer fatal mistakes, because one fatal mistake can erase the benefit of several years of higher returns. One blow-up can force you to stop contributing. One panic sale can lock in losses and make you miss the rebound. One concentrated bet can turn your retirement into a recovery project. So your job is not to impress the market. Your job is to arrive. Now, I'm going to give you a practical way to run this plan in real life without becoming a finance monk. First, choose a contribution target that's ambitious but survivable. Survivable matters because survivable becomes consistent. Consistent becomes inevitable. If you can do $1,000 a month, great. If you can do $600, start there. If you can do $300, start there. The number that wins is the number you can sustain for years. Second, automate it and treat it not option, not when I feel like, not after the holiday. Automation turns willpower into a system. Third, schedule contribution increases. If you're starting late, you don't rely on motivation. You calendar growth. For example, every 6 months, raise contributions by 5% or 10% if your income allows. Or every raise, divert a fixed chunk into retirement before you upgrade your lifestyle. Fourth, adopt the Graham filter when you invest. Keep costs low. Stay diversified. Avoid speculation. Don't overpay. Don't concentrate. Don't use leverage. And never buy something you wouldn't be willing to hold through a painful year. Fifth, create rules for bad markets before the day. Bad market arrives. This is the most underrated part. Here are the rules you quietly write for you, because you won't write them when fear is loud. If the market drops 20%, you do not stop contribution. If the market drops 30%, you do not wait for clarity. If the news says the world is ending, You reread your rules, you check your emergency fund, and you keep the system running because the market's job is to test you. Your job is to not fail the test. And now I want to address the hidden shame that late starters carry. A lot of people are not late because they were reckless. They're late because life happened, because they had responsibilities, because they survived things they didn't choose, because they were never, because they trust, because they're earning real money, because they are late. You need a plan. That late but not long isn't a slogan, it's a strategy. Build stability, build an engine, apply the Graham filter, avoid fatal mistakes, and keep going. Now, I'm going to do something most videos won't. I'm going to show you how the first 100K can become your psychological turning point, not just a number. When you hit $10,000, you prove you can start. When you hit $25,000, you prove you can persist. When you hit $50,000, you prove you can endure volatility. When you hit $100,000, you prove you can build a machine. And once you have the machine, you can improve it, you can optimize, you can add complexity only if it actually adds safety in return, not because it adds excitement. So if this is landing with you, do two things right now. Seriously, right now while it's fresh. Comment late but not lost, so you anchor the identity you're choosing today. And if you're comfortable, drop your age and the monthly number you're committing to. No shame, just clarity. The comment section becomes a room full of people building, not pretending. And save this video, not because it's trendy. Save it because one day the market will have an ugly week and you'll need to hear the calm voice again. Now, let's go back to where we started. 2:17 a.m., phone glowing, mind racing. Picture the same moment months from now. Same time, same quiet house, but this time you open your account and you're not begging it to tell you that you're okay. You already know what you're doing. You know your cash buffer is in place. Your toxic debt is shrinking or gone. Your contributions are automated. Your investments are diversified and boring on purpose. You're not relying on a miracle. You're relying on a system. And the most important change is invisible. Mr. Market can scream whatever he wants, and it doesn't control your hands anymore. That's what Graham gives late starters. Not a get-rich fantasy, but a framework that protects you from your worst impulses and from the market's worst moods. So here's your final move. The one that separates people who watch finance videos from people who actually retire with dignity. Tonight, set the automation. Pick the number, even if it's small, even if it feels unimpressive. Make it real. Then write one sentence and keep it somewhere you'll see it. I don't need to catch up fast. I need to avoid blowing up. Because the first 100K isn't the finish line. It's the moment you stop being late and start being inevitable.